Market tension is high as we head into tomorrow's inflation report. Today's session was a tale of two extremes. Oracle surged on a massive AI-driven earnings beat, while a sudden 60% collapse in a subprime lender signaled widening cracks in credit. With oil prices also plunging over 11%, we're seeing a sharp contrast between tech momentum and macro stress. Today's macro setup was volatile from the open. The chart captures a sharp intraday swing, but the clearest macro signal is in energy. Oil dropped about 11% as the IEA discussed reserve releases. That volatility sets the backdrop for our main hotspots: the shifting AI infrastructure trade ahead of NVIDIA's GTC, tomorrow's critical CPI release, where consensus sits around 2.4 to 2.5%, and the stagnation we're seeing in housing volume and dividend funds like SCHD. We're tracking three major hotspots today. First, the AI infrastructure trade is shifting into high gear with Oracle's cloud results and anticipation for the upcoming NVIDIA conference. Next, all eyes are on tomorrow's CPI release. Consensus expects a print between 2.4 and 2.5%, though Sunny warns that a hot number, even before recent energy shocks, would be a major headwind. Finally, housing remains stagnant. Eurodollar University reports that while sales rose slightly in February, volume is still near depressed levels as the credit cycle shows signs of acute stress. Oracle's latest results gave the AI infrastructure story a major lift today. The company reported a 44% jump in third-quarter cloud revenue and raised its fiscal 2027 revenue target to $90 billion. Management noted that this momentum is being sustained by the strong financial health of their largest AI customers. Traders are also crowding into NVIDIA options ahead of next week's GTC conference. Poll reports that open interest for March 20th $200 calls has surged 30% recently. This positioning suggests investors are betting on major hardware reveals, including potential second-generation optical switching technology. However, as the gauge indicates, this high-stakes positioning increases the risk of sharp volatility if the event doesn't deliver a perfect surprise. While technology leads the indices, the credit cycle is showing acute stress. Subprime lender GoEasy saw its shares drop 60% today after suspending its dividend and disclosing $330 million in charge-offs. Unrivaled Investing reports the company is projecting mid-teens loss rates for 2026. A key diagnostic alert here is the auto lending ecosystem, where repossession firms are already operating at full capacity. This pressure is starting to bleed into the broader market. Did and Bull notes that over 10% of the business development company sector has already announced dividend cuts this year as income falls under pressure. The subprime stress is spreading into business development companies. Dividend Bull reports that over 10% of the BDC sector has already announced dividend cuts this year. At the same time, relief from the Fed looks unlikely in the short term. Market odds now suggest a 99% chance rates stay exactly where they are through March. This keeps borrowing costs high for these lenders. And as the diagnostic alert on your screen notes, the gap between reported defaults and market pricing is starting to close fast. The housing market remains stuck in neutral. While existing home sales rose slightly in February, volume is still hovering at what Eurodollar University calls depressed levels. The channel argues that lower mortgage rates won't fix the market on their own because labor fragility is shrinking the buyer pool. With median prices holding flat at $398,000, buyers are caught in a vice between high structural costs and growing job insecurity. We're also seeing emerging evidence of localized credit stress. Eurodollar University reports that mortgage delinquency rates in certain high-stress areas of Texas have reached 25%. While these figures are regional, they underscore a broader trend of demand constraints and prospective buyer exhaustion. In today's signal sweep, keep an eye on the March 23rd rebalance for SCHD. Dividendology projects a major defensive shift, with energy exposure expected to drop from 20% down to 12% as the fund rotates into financials. Meanwhile, Berkshire Hathaway is reinstating share buybacks. Sven Carlin notes that as falling yields make cash piles less productive, management appears to view current prices as sitting well below intrinsic value. Finally, managed care margins are facing a serious test. Nana reports that Centene's ACA enrollment fell drastically this past quarter, dropping from 5.5 million down to 3.5 million. A smaller pool like this often implies a worse risk profile, And with higher costs per user now hitting margins, it's creating a major structural headwind for the entire sector. Looking ahead, tomorrow's February CPI release stands as the primary risk for the markets. Sunny warns that investors are heavily priced for a perfect soft landing, with consensus expecting year-over-year inflation between 2.4 and 2.5%. The danger here is an upside surprise. Even before factoring in recent energy shocks, a hot inflation print could act as a massive macro headwind and trigger broad selling across the board. That's the recap for Tuesday, March 10th. We're watching Oracle, BIZD, and NVIDIA as the key signals ahead of tomorrow's inflation report. We'll be back then to break down the CPI data and the market's reaction. All sources are in the description. Subscribe to stay updated on the signals that matter.